Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
So, welcome back everybody. This is the second episode of the Finance Garage. I'm Jonathan Wu, Principal and Senior Financial Advisor here at the SWU Group. So, for my second episode, I have Tobias Bucks, who's a Portfolio Manager at Ausbil. He's the Portfolio Manager for the Ausbil Global Small Caps Fund. I've known Tobias for about 2.5, 3 years. So welcome, Toby.
Thanks very much. Glad to be here. Cheers, Jonathan.
So just to kick things off, we call this the Finance Garage for a reason. Before we talk about the garage and some cars, give us a bit about your background.
Thanks. I've been doing small caps my whole career, which is coming up 20 years now. I'm from the UK originally, and I've been in Australia for almost 14 years. The Ausbil fund, the Ausbil Global Small Cap Fund that I run has been coming up 6 years. And my real passion is global small caps. I think because they're just really exciting businesses and you get the best returns out of them. So you can make a lot of money and there's always a bull market somewhere, so you can always find something interesting to invest in. Outside of work, I'm a father to 2 great kids and I try and enjoy the finer things in life. I like sport, I like automobiles, which we're going to talk about, which is a keen thing for me, and I like investing. I think one of the reasons that the markets are so interesting is they always just show you how small and how little you know. And
yes.
That's one of the things that I really enjoy. So I guess that's part of me is hoping to learn more out of markets going forward. I'm a bit of a market junkie.
Sounds good. Now, let's talk quickly about cars. So just before we started recording, we talked about something quite interesting because both of us recently went to Sydney Motorsport Park, but with a slightly different mode of transportation. So for those of you on the podcast that have ever gone to Sydney Motorsport Park, I think it was actually primarily originally built for biking, for MotoGP. And so I went down in my Porsche Cayenne, which is a very, very heavy car. And I was really proud of myself for hitting the straight VMAX 220. And then you said something, Toby, that I just went, I can't do that. Can you share with the audience what you did?
Yeah, you can go a lot faster on a motorbike. So yeah, I hit 266. I almost got to 270, but not quite. Very close. Next time I go, I'm going to go through 270 for sure.
Oh, and what was your mode of transportation?
So yeah, I was on a Suzuki Generation 1 Hayabusa, so they're a lot faster than cars. Oh, no, I think you're right on that track being built for GP, because I don't know if it's at corner 4 or corner 5, there's a camber.
Yes.
And obviously the camber on a bike's a lot better than a camber on a car. I know your cars capture more of a camber because you're wider, but you need a camber on a bike if you're really going to go for the corner.
Yep.
And so, yeah, it's a great track.
It is a great track. And my comment, if you recall, I said that if you hit the wrong part of, if you get to the wrong part of the apex on turn 1, and you find yourself in an area that let's call it less desirable, I believe that your Suzuki is going to be wearing you for protection as you hit the wall.
Yeah, for sure. I've missed that corner a few times and been up the gravel strip towards the tyres, and then it's really sad. You have to go on this little ride of shame. You have to do this zigzag behind the tyres and they have to go all the way around on the back road and join after corner, whatever it is, corner 2, because they won't, or corner 1. So it's this whole little lap of shame, and then all the guys in the pits can see you doing it, and of course You know, when you're there on a race day, you don't, you know, it's a natural fear that you're the biggest monkey there. Like,
Yes.
you know the least, and you're the least cool, and you don't know anything about engines. And yeah, and then when you have to do the ride of shame, it's even more embarrassing. But yeah, but that's if you miss it, because if you don't, yeah, because obviously you want to go as fast as possible. That's the whole point of going to the motorsport park, and that means just gassing it. And if you've got gears, then that just means trying to get to top gear as you know, smoothly and as possible. You don't really think. I think my biggest problem is I don't really think about braking. I'm like, I just want to get up to the highest gear and as fast as possible. And then you see the grandstand just like start flying past you on the right, and you see the 150 brake sign, and you're like, oh, I really should have started braking by now. Yeah. The good news on a bike versus a car is on a bike you can get from 270 to like 170 within like 50 meters. You can slow down a lot quicker.
I'm just thinking about at what point, if you slow down far too quickly, at what speed at which you slow down too quickly, you'll end up over the bike.
Yeah. Right. Well, and that's luckily, you know, not something I'm going to push the limits on and find out. I mean, I try and ride within oneself. I've got kids, and obviously, I think it's important to note to all the listeners out there. There's 2 fund managers on this fund. I've been running money with a guy called Simon Wood since 2007 in the UK, and then we run money here. So the key man risk is much reduced by having 2 senior portfolio managers.
That is very, very, very good.
What's it like on the car though when you start braking? Like where do you start braking on the car?
So I think it's the 100 meter.
Yeah.
I think it's the 100 meter sign. I start hitting it, and that's where I hit sort of 220, and then I'm hitting turn 1 at about 130. I think I maxed out at. I couldn't get any faster, and the main reason was because at turn 2, as you know, you're going round and then up.
Yeah.
Then the physical limits of the car I felt. Now, to be fair, I hadn't done a track day in about 12 years. I did one with Mercedes about over a decade ago. But the issue was, Porsche's really good. They've got coaches, and then you have coaches that can come in at any time if you request them to jump in. And I said, can you sort of tell me if I'm pushing the limits? And he said, just do a lap. I did a lap, and then he said, and I asked the coach, how do you feel about it? And he said, well, you have not lost any traction. So even though you feel that you're in this big, gigantic SUV, and as you're cornering, you feel like you're going to roll, the car's not going to roll. It will never roll unless you actually leave the tarmac, right? Yeah. And even before you roll, you will lose traction. The back end will fly out, right? And if you haven't felt that at any point during the day, you won't have any trouble, right? But it does feel very heavy. We're talking about camber, right? Getting into that, whatever that corner was, like getting round, it's very, you feel the limits of your car, like just...
It's 4, it's corner 4.
I think it's 4.
Yeah.
Because when you go really hard on the brakes in my Cayenne, it is really the front end just basically just stomps down. You feel it like really, and I've got air suspension on mine, and it still just basically throws the car down really aggressively.
You've got that much weight transfer, right? You're moving 2 tons.
So 2.6 tons, of which 250 kilograms is battery. Right now, there's a good part to that, right? Because your center of gravity, because the way the bat packs are loaded up is at the bottom of the vehicle, right? Yeah. So it lowers your center of gravity, but you genuinely feel a lot of weight coming through.
I reckon you'd go faster on the straight. Not trying to tell you how to suck eggs, it was different. But that corner 1 is a slow corner. So it's a fast corner. I mean, super fast corner. I've seen a guy take it at over 215 on a Ducati.
Yikes.
He was really hanging off, like shoulder on the tarmac, but he had it at 215 on that corner 1. Lots of people can pull 190. I reckon you've got more grip in a corner than a bike. Yeah. I reckon cars can get up to 150 on that corner, 160.
Yeah, I think so.
And the thing is, on a bike, you can feel, because I don't have any traction control to turn off or on, but you can feel a bit of give, and you're like, oh, okay. I'm already, you feel it, and you're like, okay, this is, I need to rein this in a tiny bit. Yeah. So. But I love all the different forms of cars. What cars have you got?
So I'm in my wife's drives BMW X3 because shuffle kids around. I've got my Cayenne. I've had my previous car to that was an Audi SQ5.
Yeah.
which was nice. Prior to that was, well, I did 5 years with Lexus, which we talked about previously.
Oh, yeah.
And if there's any audience members that own a Lexus LC500, I'm very interested because I think that's going to be a vintage car one day. All right. We were talking about this, right? Even you were surprised. There is almost no modern production car that's still being produced today that is a naturally aspirated 5-litre V8. Right, everything's electrified, turbocharged, supercharged, right, to effectively deal with the Euro's emission standards, right? So you just don't get the sound out of it, and everyone that
Or the rumble, or just
the rumble,
rumble.
correct, cold starts, the whole
Yeah.
the whole kit and caboodle, and the issue is that when you flick on. Most of the people that have bought the newest generation, and we'll talk about this, the C63 AMG from Mercedes, right? It's a 2-litre 4-pot, right? Okay, it's electrified and then it's turbocharged and then whatever. But there's a lot of people now that actually want to sell the cars, and the second-hand market for C63s have plummeted because 10 years ago you got a 6.2-litre naturally aspirated V8, and now you got a 2-litre 4-pot. It produces more kilowatts because you got no turbo lag, right? So your 0 to 100 is technically faster, but it's just not the feel. And you buy an LC500 not because it's the fastest car in the world.
Yeah.
My Porsche Cayenne is faster than the LC500, but it's just the feel,
Yeah.
right? And I think that's probably the issue that I have with buying a pure electric car as well, is that so what if you do it in 2.5 seconds? There's no sound.
I asked that question I took my bike in to be serviced, and they tried to sell me, not sell me, they tried to pique my interest in an electric bike, and they were telling me about the acceleration. I'm like, well, I've got a Hayabusa, like I've got acceleration, I don't need any more of that. It's already dangerous enough as it is. And then he started saying, well, I was like, what sound does it make? And he said, and then he got me, because they said it makes it sound like a jet engine. And then he played me the video and he turned it on, and it did, as much as anyone who likes motorbikes probably likes the whole Top Gun side of motorbikes,
Okay.
that whole sort of side of fun, and I definitely do. And when I heard the engine go, it does sound like a fighter plane, and I was like, okay, well, that's the 4-year-old boy in me.
Goes, yes.
Okay, it doesn't sound like my Hayabusa with 2 massive exhausts. It's awesome, but at the same time, it's a different sort of cool, you know? And that got me, because it's like, that got me excited. I think the sounds, everything, like, your body is the center of your identity, and also your car is in the modern world now. Like your horse probably was before, and now it's your car.
Yes.
So your vehicle. So yeah, the sound's super important, the look's super important, and the feel when you're sitting, like when it goes.
Correct.
Like how you could have it. I haven't sat in one of those new 663s, but it not to have the whole thing rumble would upset me. I had an old ML500 that I used to really enjoy, just because the engine, like I say, it's that naturally aspirated 5-litre. It just goes vroom.
Correct.
Yeah, the W63 or whatever, 163. They're good business, good cars.
Correct. And the fact of the matter is, it doesn't matter how fast it goes from 0 to 100. We'll basically lose our license with anything that we drive nowadays, right? With that speed. But talking about risk, let's move on to small caps. Now, we met about 2-ish years ago, and at that point, you talked about this particular dynamics of the market back then, and it was challenging, right? It's probably the best way to put it. Can you unpack that for me? Because I think that sort of sets the scene to where we are today, and the opportunity set that presents itself is far more different. Can you sort of set the scene for us?
Yeah, I remember talking to you at the time, and there'd been a big run since the COVID lows. I think we can get on to why small caps are attractive and stuff, but just in terms of where we were, I felt that the market had got a bit pricey, and that the market was discounting quite a strong outlook, and it was going to be quite difficult for valuations to really improve that much to give you a return worthy of the risk that you're taking, because you're always taking risk investing, and you got to take on risk to enjoy life, to get returns, but you've also really got to understand and unpack that risk. I think we could see inflation coming and could see interest rates going up, and I think that outlook, the first move in interest rates is going to be bad for growth. It's going to be bad for risk, and I think when you see valuations not offering that much upside, it's about risk and return. You're just not getting that much return, and I think those are some of the things I was trying to explain to you. It's never the right thing to do as a fund manager, not to ask people to give you money. But at the time, and definitely within our chat, I think I was pushing back on you guys investing, given what you were after. And I want to do exactly what we say we do on the tin, which is give you the returns that we think we can at the risk that people take on. So yeah, the market had run really hard. And actually what happened, luckily, was that it wasn't a good time to put money in to the asset class or into equity markets. And I'm glad I was as brutally honest as I normally am. Can get me in trouble sometimes, but especially if your girlfriend asks you what she looks like and stuff. But I think at the time things were expensive. You roll forward to where we are now, and we're talking about late 22 there, right? We roll forward to where we are now, August 2024, so 2 months shy of an election, potentially a few weeks, 3 weeks shy of what's expected to be the first rate cut. And that's expected to be a benevolent rate cut, focusing on keeping real yields in an attractive area as inflation's come down. Inflation was rising 2 years ago, which made it very difficult to handicap how high rates would get. Nowadays, inflation's falling, difficult to handicap, but I think we can assume in the near term, for the foreseeable future, roughly what it's going to do in the next 6 months, especially inflation with rent and shelter being such a big part of it. We can see where inflation's going. So pretty sanguine on where inflation is, and also that rate cuts are coming, not as many rate cuts as the market. What does that mean in layman's terms? It's a better setup for higher market prices for equities. Why? Because the market is assuming continued growth, and I think that's going to come through, and that they're not going to get any liquidity headwinds. I think what happened when rates moved aggressively at the end of 22 and 23, for 20 years we've had low rates ever since Greenspan. Fixing the issues of the liquidity crisis of the GFC brought even lower rates, and then the Euro crisis, even lower rates. So we've had low rates, call them synthetically low, call them what you want, but they've been low. And if the risk-free rate's zero, then the required rate of return for more risk steps up from that. So, for investment grade quality bonds, you can expect 2 to 3% return. Step through to junk at sort of 10% return. And likewise for equities, large caps can probably give you a sort of 5 to 8% return, and small caps can give you an 8 to 10% return. In an environment where interest rates are sort of the risk rates at sort of 3%, the required return from riskier assets steps up with it. And small caps are riskier than large caps. Not very much, but they are a tiny bit. So now you're expecting a sort of 12 to 15% return. So when valuations are too high, and back when I was saying, look, there's probably a better time to give me money to make you more money, there's a better time to do it. What I was saying is, markets have to adjust here for the change in interest rate environment, and they haven't.
So I think what I'm interested in as well is we've gone from, if you think back just 8-9 months ago to the beginning of this calendar year, we went from predicting 6 to 7 rate cuts to 0 in, what was it, June?
Hikes,
sorry.
Yeah.
Hikes, right? 6 to 7 hikes. And then 6 months later it went to 0 hikes because soft landing, to now I think that it's about 100, the market's pricing at 150 basis points. I saw something from JP Morgan yesterday, 150 basis points in the next sort of 12 months, I think 52 weeks was their scale. How does that impact, given the fact opinions are literally changing by the day and 10-year bond yields are being repriced every second, does that factor a huge part into what you end up investing in? Because that in itself can generate a whole lot of volatility for you, right? If you're having to pick your portfolios based on basically going each side of duration violently or moving violently constantly, right? Does that sort of make sense? Is that an issue for you?
Not a huge issue. I mean, duration affects all pricing of risk because duration affects pricing of future returns. So, the very, very nature of it. But for us, not really. I think it's when the environments change, you have to be aware of what's going on. I think the real question an investor has to ask yourself is I mean, duration's a measure of sensitivity to interest rate risk. If interest rates move by this much, what's going to happen to the valuations of the businesses in my portfolio? And that's sort of the key question. At the moment, yes, we've seen expectations of interest rates 5 to 6 hikes move to no hikes, like you say, to now cuts and now even more cuts. But in that time, the outlook for sort of the 10 and the 30-year interest rate environment hasn't really changed. So that's the sort of my understanding, with my way of thinking, would be the investment market saying pretty easy to handicap the interest rate environment over the next 30 years, quite difficult to handicap in the next 2 years. And that's what's happened. So, but what we saw in 22, it was at the end of 21, actually, that we first started talking. Not 22, sorry.
Yeah, it was
the end of 21.
Yeah, that's right, yeah.
If you look at what happened in 21, the whole yield curve moved because expectations for the price of borrowing further out moved. The whole environment changed because we'd been stuck in a different period for 20 years. So there's been a lot of volatility in interest rates, but the volatility in interest rates really has been about near-term interest rate expectations, not about the real yield. And I think what scares the market about the Fed is when the market thinks the Fed has lost control or lost focus on the real yield. When the market thinks the Fed's too complacent, that's when it gets scared. So you saw that in the autopilot comment in 2019, and you saw it a bit this year when the market was concerned that the Fed wasn't that focused on unemployment numbers or the real yield. They were just too focused on inflation, and then Powell adjusted what he said, and I think he's done a great job. The market's sanguine that the Fed's going to focus on real yield and not going to let the economy tank.
Yeah, okay.
So it's a very different environment now. And you've seen that in asset prices. So you've seen volatility in the 10-year yield, but it's not caused the same effect on growth businesses as it did sort of in the back end of 21.
Let's talk about your ideal investor, okay? And we talked about this concept of momentum, right, and the risk, right, as a small cap manager. Can you sort of unpack briefly, if you're going to invest in small caps, right? Because it's I don't think investors sit with their financial advisor like myself or just, Googling the next best investment opportunity. Excitement doesn't equate good investment. Okay. If you are willing to accept the risk that small caps come with it, we discussed briefly that the biggest risk is momentum in a portfolio, right? So if you were considering, and the audience is considering small caps, what's the type of person or what do you need to bear in mind if you're going to invest in this because you want that longer term return profile?
That's a great question. I think when you look at investment opportunities over the last 100 years, you get a different picture than when you look at investment asset classes over the last 20 years. So I would look and regard small caps as an asset class based on the last sort of 100 years of their history of risk and returns, not what you've seen in the last 20 years. In the last 20 years with very low interest rates, it's been about globalization of financial engineering, and that's benefited sort of amalgamation of debt plays and amalgamation of asset plays. Big growth opportunities that are very heavily levered that can maximize on scale. If you look back over 100 years, the businesses that have tended to provided the best returns of capital, whether you hold a bit of the debt or a bit of the equity or how you're invested in that business, it's the businesses that have the ability to continue making and servicing customers, making products, serving customers, continue to grow and stay ahead of changes. Those are generally small and medium-sized businesses. They're rarely big businesses. In fact, you see big businesses really struggle with change. If you look at the returns and the risk of equities going back in history, what you see is that small caps provide a much better risk return than global large caps. Equities also provide a much better risk of return than a lot of other asset classes. Now, there's lots of differing research and everyone wants to put forward their own asset class, and I've been an equity guy my whole life, so I'm always going to push forward equity. there are a lot of investments that are made at the moment that aren't liquid, that aren't marked to market, where a lot of people have put money in private debt, in real estate, and they don't know what they hold and they can't get it back. And if they asked for it, they might not be able to get it back at the price they think. Equities and debt markets are very attractive, the ability to be liquid and return money to people. And I think, if someone's wanting to give you their money, the first question is, when do you need it? So, if you need your money at any time in the next 6 months, I would advise investing in a liquid market, so an equity manager or a debt manager. So that would be someone, if you want your money tied up for a long time or a short time, that's someone who could come and see us. And that's important and overlooked, I think. And then return. Why are you giving the money? Do you want to be able to draw on the same amount of money later, or are you hoping to create some sort of positive return as well? And then that's the whole area that your expertise fall into, Jonathan, not mine. But if you are investing money to grow, and that's basically debt markets and equity markets, then you should want the highest return for the most attractive risk, and you should diversify. I mean, this is pretty basic stuff. The best risk-adjusted return in equities is small caps. It's global small caps. I mean, that's been proven by S&P and lots of other research that we can quote and deliver, and we've spoken about that before many times. So for clients who want to invest money and want it to be liquid would be my ideal client, and then a client who wants a good return and who's already invested in equities. If you have any money in equities, if you invest in the NASDAQ or you invest in BHP or CBA or any business in Australia, and you want to have money invested in equities, you should have money in global small caps.
Sure.
The actuarial science proves it. What we've seen in the last 20 years is the NASDAQ and large cap tech stocks have outperformed, because people have wanted that growth, but they also want that security of growth, that they're willing to get smaller returns for a more assured growth. Small caps have traditionally delivered higher growth than large caps, which makes sense because they're smaller. They have a much better risk-adjusted return than large caps and mid caps. Essentially, they provide only a smaller bit more risk, but for much more return. So generally 3% higher return a year. So I think my ideal client would be someone who, is concerned about their money, doesn't want to just throw money away and not find out where it's gone, wants to check on their investments, wants to be able to access their investments, and I think they've probably already got money invested in equities, and I think global small caps is actually the place they should have started, but no one ever does start there, and they should be adding global large caps and domestic small caps and domestic large caps to their global small cap portfolio. Now that's a biased opinion, that's my opinion, but it's based on the things I've read and seen. And I think you shouldn't view small caps as something that's more risky than large cap materially. It's not materially more risky. It's risky. You can explain all that to your clients, but once you're in equities, whether you're in a large cap or a small cap, yes, your company can suffer company-specific stuff, but if you walk into a GFC or a .com, it doesn't matter really what you're holding, they're going to get hit.
Correct.
And you want to be in something liquid then.
It's sort of interesting you bring up this point. So in the last, we always tell our clients that there's only one free lunch in the world, and that's diversification. And in the last 4 years, we have allocated some of our clients' money into private debt, right, which has been good. The issue then has also then become that they go, to your point, private debt's great. Like, it doesn't move around. Unit price stays at $1, right? Get my monthly income. I just want that, because I don't really want equities, because this stuff's volatile and I don't like up and down. And, I just recently spoke to another advisor, said, do you use private debt? He goes, yeah, we use a ton of it. And I go, why is that? Because crap hits the fan, right? And equities fall. The clients don't see that the private debt went bad. And you know what? That's probably the worst thing you could ever do when you actually communicate this stuff to clients, right? You have to, at the end of the day, everyone needs to find a way to make money. If you're investing in private debt, I use this term, let's say private debt gives you 8-9%, okay? Depending on what type of risk profile you're willing to take. A manager needs to make money. Let's call that 150 basis points, right? So that takes you, if it's the return to a client is 8, that's 9.5% at least that the person at the end point the corporation or whoever is going to borrow at 9% and willing to happily pay 9.5% interest per year. That guy's not an idiot. He's not borrowing 9.5% to make less than 9.5%. So longer term, I've always told clients that equities will outperform debt because it fundamentally has to. I try to keep things simple, right? It's borrowing 9.5% to make 7%, right? They'd be an idiot to do so, right? But you have to understand equities and public debt have this magical thing called mark to market.
Yeah.
Right? It is a place where buyers and sellers come to meet to determine a market price, right? That's all it is. But being well diversified, and you hit the nail on the head, you shouldn't be scared of small caps just because of the term small caps. To be honest, if you look at the small cap industry globally, they're a lot bigger than the Aussie small caps.
Yeah, yeah. I mean,
so can you sort of talk about that? What's your market cap?
that's something that it's important to get across, and once society's chosen the names, you can't change it. But so we're global small cap, and that's effectively the smallest part of global equity market. So global small caps would typically have a market capitalization between 500 million and 10 billion US dollars. Domestically, that would put you firmly between the ASX 200 and the ASX 100, if I'm not mistaken. I'm pretty sure. So we'd be, in terms of risk and return, or in terms of risk, it'd be similar to your domestic large cap offering that you're already invested in. However, over time, historically, we've produced a higher return, and I think we should in the future. Domestic businesses are well researched and well invested. Ausbil, the company that I proudly work for, has got over a 25-year track record investing domestically and then globally. And our domestic funds have got an excellent market-leading track record that we're very pleased to show and talk about. As well, we do believe that offshore should provide a higher return to the Australian market. People are already invested in the Australian market. They're already invested in small caps in Australia. This is why they should be very keen and have their interest piqued by what's offered globally. What's on offer globally is a lot more of all the different industries. So we've got a lot of exposure to the grid upgrade and the electrification of the world. Different markets, and there's always a bull market in global small caps. So obviously we've got Europe, broadly Europe, Asia and the States, whereas domestically it's much more focused on the Aussie market and the Chinese economy, which is driving it. And I think the biggest one is the management teams have improved quality. There's some fantastic management teams in Australia, but when you go offshore, there's some even better management teams, particularly coming out of the US. And then another point that's sort of missed is domestic businesses sometimes in Australia have struggled to go overseas, and there becomes a point in a growth cycle where a business has to keep growing, has to expand its geography. And that's been quite difficult for Australian companies. Companies in Europe and in America, particularly America, have a lot easier run rate to go through that revenue scale to become a bigger small cap company, because if they're in Texas, they can just go across the border to Oklahoma, and so you've got a much easier expansion. Also, your reach is implicitly a lot bigger as a global company, because once you've got an office in the US and you're servicing an industry in the US, it's not that hard to move to another state.
Yep.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Talking about grid upgrade and CapEx, which I know is a theme within your portfolio. As most audience members know, I'm quite familiar with investing in Asia and particularly China. And so, in 2023, China led the world in new energy by adding 65% of all new solar capacity globally, which is equivalent of about 250 gigawatts. And by the end of 2022, the global total was only about 1,100 gigawatts. Now, the US and European grids have got legacy issues. They're very old, right? Generally, their industrial age was, yonks ago, right? So how do you see that as an opportunity? How does that feed through? Now, just noting to everyone that if we do talk about any companies, that these are only for illustrative purposes only, right? Some people love to listen to this podcast and just buy the names that, Toby may say, but just be warned, this is all about investing in a diversified portfolio, not just in individual stocks. So, Toby.
Yeah, thanks for that. I don't want to buy a good stock and then it goes down.
Yep.
That rarely happens though.
It never happens.
No.
Never.
Look, I think just very broadly at the outset, we generally run about 60 positions in our fund. That's what we think is a good idea. About the moment, about 40% of the fund's invested in industrials. That's sort of double the index weight. And at the moment, about sort of 25% of that 40% is directly related to the grid upgrade. So that's just generally where we are. We've got a lot of uncorrelated ideas. We're a core manager. We make a lot of money out of grocers, out of consumer discretionary, and healthcare as well as we do, IT and industrials. So I think the grid's really interesting. I think one of the key things about global small caps is there's always a bull market somewhere. And as an investor, I found over time is that your portfolio wants to have, be centered around some core stocks that can deliver over time and lack volatility in their end demand. They tend to be more of the industrial or healthcare nature or grocer, staple nature, those types of businesses. But you want to have some of those in your portfolio because you need some just steady performers. And at the same time, there's always an area of excitement. And that's great if there's really tight capacity, highly profitable businesses. It's not great if there's any capacity you want, very profitable businesses. But there is always a bull market in global in somewhere. And I think with energy, to my way of thinking, all roads lead to Rome more than I've ever seen in my entire career. So the grid has to be upgraded, and there's a number of things going on in the world that are going to mean that's going to happen in a price-taking way. Like they are not going to be discerning on how much they pay for the equipment to upgrade this grid. Why? The move towards net zero, regardless who wins the US election or that election, we are moving towards net zero in the US and in Europe, and spoken about it in China as well as centrally planned economy. There is legislation in place to make the move towards net zero happen with the grid. The grid is going to be upgraded. And as the CEO of MCOR said, one of our holdings, this isn't the energy transition, this is the energy expansion. And I think that's really true. We're going to need sort of double to 3 times the amount of gigawatts that we used to. More importantly, we're going to need grids that are a lot able to move stuff around. So we've got this move towards net zero happening. We need to make the world decarbonize energy, generation, consumption, and mobility. That's a general need. Then, as you just mentioned, without any of the change in demand for gigawatts and geography of gigawatt demand, in Japan, the US, and Europe, the grid is the oldest compared to the rest of the world, almost twice as older as the Chinese grid that you mentioned, and it averages between 20 and 40 years age, depending on what parts of distribution your transmission you're looking at. So that needs to be replaced anyway. It's just reached its useful life, and it's all sort of built in the 50s and 60s, and now it's coming south. Now it needs repairing, so you've got those 2 major reasons. And then we've got the need for renewable and decarbonised consumption. So renewable generation and charging your cars at home is a major driver. Then we have the fact that the grid's just really old. And then the third factor we have for the grid is this demand for AI. The AI is currently in an arms race to produce general intelligence. So it's not about return on investment. It's a first past the line. Story here, so I'd caution people on looking on return on investment at the corporate level for AI, which I think if you look at the Dell comments is coming much closer than people think. So we do invest in the picks and shovel of AI in the grid, and we would advise people to. I think this early innings chat is accurate, and as I say, it's not about return on investment, it's an arms race to the finish line here, or the first finish line.
At the moment, correct.
Base camp. So there's this huge demand for data centers, expected to be sort of go from 4 to 8% of US energy demand in the next 10 years, and global data center demand to be equivalent to the energy demand of Japan within the next 10 years as well, as another quote being thrown around. So huge increase now in amount of generation and where it's going to go. And this is being driven, as I said, by things that are going on in society that I don't think are going to change. One, that we need to decarbonise is the general belief. Two, we want electric cars. They have more torque. They go faster. They have fewer moving parts, so less likely to break down on you in cold weather.
Needs, yes.
Yeah, so that's why, from a garage and finance point of view, we need electric cars. We've got to charge those cars. And at the same time now we've got AI rapidly increasing demand for data centers, and the data center demand is going to increasing at the moment from the trends we've seen in the IT sector from the last 10 years, not because of AI yet. So because of these things, we've got to upgrade the grid. It doesn't matter who's in power, it doesn't matter how much it costs, and we'll get onto that. We've got to upgrade the grid. And I think that's where it's interesting, is getting into the nitty gritty. ENTSO in Europe legislates new grid capex plans from all the members of Europe, and the states' local grids are also forward planning their capex for the demand that's coming. When you look through those plans, they're quite detailed in terms of kilometres at the moment, but not in terms of substations. We have to change the transmission highways first, so we need to build new motorways. The transition in highways are these big, high voltage transmission routes in countries. We've got to rebuild those cables first, and after that we can change distribution.
So just to stop there, I mean, these just so people understand, these ultra high voltage, because I've looked at the ones in China, right? Effectively, it's the ability to transmit energy from the source. Let's call it renewables, right? That's what I'm used to looking at in China, solar and wind, where it's sort of efficient around the Gobi Desert. The biggest challenge is actually getting that energy that's being generated to the coast, right? And so I've seen these maps comparing US and China, where the ultra high voltage, I think, is 800 gigawatt lines. So I think that's the term, because the bigger the hose, the more energy you can put through it. So, but you also lose less energy through the transmission mechanism as well, right? That's the key.
That's the key. So I've had heaps of fun. As I say, there's always a bull market somewhere in global small caps. I spent the last 4 years relearning a lot of physics and electronics. So effectively, the higher voltage, if the power is the same, the power transmitted is the same. But the higher the voltage, the less resistance. The lower the voltage, the more resistance. So on these transmission highways where we want to transmit electricity a long way, we need to run it at 540,000 kilovolts. So huge amounts of volts. And then you move that energy to a place, into a substation, and then you step it down with a transformer to medium voltage for the local areas, and then low voltage for the buildings and stuff. So yeah, you need that really, really high voltage cable to not lose. The efficiency of the grid's a huge area. So that's, it's a really interesting question. I find it really interesting, and if you're a nerd and you're into cars, you might find it interesting as well, because at a base level, the way to make the grid more efficient is to make sure that you're always transmitting at the right super high voltage and then dissipating it. But actually what we've got going on in the grid in the next 10 years, 20 years is so much more exciting than that. There's different types of power. There's sort of standard power, what we call real power. And a real power is effectively a load, like a heating element, an iron or something. And then we have something called reactive power or inductive power. And inductive power is the power that's required to create a magnetic field to allow something to happen. So induction is basically an effect of the magnetic effect of the electricity being passed through something at a certain type of resistance or a certain way. In the olden days, we used to have a big coal station that had a big power line that went through some houses and some offices to a zinc melter or to some massive industrial asset load. There was induction in the line because the line carried a lot of volts, but not that much induction. So you need capacitors at certain points of the way. What happens with inductive power is that if it's not used in the right way or understood in the right way, you can require a lot more gigawatts to do the same amount of work. Why that's important in the new grid is we're going to have a lot of renewables. So instead of having a lot of generation assets that are nuclear or gas or coal, it's still going to be gas, we're going to have a lot of battery, which is direct current, not alternating current, and that's going to need an inverter. And we're also going to have a lot of renewable transmission, and that's going to change the inductive nature of the grid. What does that mean, and what's the opportunity? People are starting to grasp the fact of why transformers and industrial scale, grid scale inverters are important. Because they can see that you can make the grid more efficient, you can harden it. But I don't think the market's really understood yet is the need for inverters and capacitors at an industrial substation scale to manage the different types of assets and all these different types of power we have. Mm-hmm. Why that is because the difference between having a grid that doesn't have the right amounts of inverters and capacitors in the right area versus a grid that does have the capacitors in the right substation could mean 2 or 3 times the amount of power. Because real power and inductive power affect each other. So if you don't have a capacitor in the right place, you could need 3 gigawatts or 3 megawatts. But if you had the right capacitor in place, you could only need half a gigawatt or half a megawatt. They're that important. Now we know about capacitors in phones and stuff, we don't really see them in industrial assets. And in the inverters and the capacitors that you're going to need for the new grid, it's a huge area. And we're invested in it and we're already making money, and I think there's a huge opportunity for clients here to invest in the Ausbil Global Small Cap Fund because of the energy transition. Market is not discounting the future growth that's going to come from some of these key product components. And we do own the high voltage cable manufacturers, the ones that we like, and they've been profitable. And transmission's coming first, and the market's getting its head around transmission. Distribution doesn't start till 2030. So we're still a good 5 years away from that real demand on the substation distribution stuff. And that's transformers, inverters, capacitors, surge protectors, and all the equipment you need. Okay. So the grid's changing. The components are changing. We're going to need a flexible grid. They're going to call it a FACTS. You're going to see FACTS. It's flexible alternating current transmission system. Okay. The difference you can get in efficiency is huge. Why that's important again, and I think there's just so much in this rabbit hole, so I mean all roads lead to Rome. To do all the things we want to do in society, we've got to do the grid first. You can't have an electric car, you can't have AI, you can't have a wind turbine, you can't have a carbon neutral building until you fix the grid. So all the things are wrong, so they've got to be done. Then we're moving to a new type of grid as well, which is going to require new components. And I think the third bit on that is the market's currently talking about dollar values for things to be spent. And why it's important to have an efficient grid and put in capacitors and put in inverters is because there's a huge amount of money that needs to be spent. More money than I think people realise, and it's going up every year. We can come back, but the 2 Aussie transmission projects are already up 300%. We got the copper project in Queensland and the renewable project in Energy Connect in South Australia is massively over budget. It's about the kilometres and the pieces of equipment need to be put in, not the current dollar amount people are currently estimating. The current dollar amount's completely wrong because it's based on what it cost them 5 to 10 years ago to get a transformer or get a capacitor or build a new substation, but that money's going to be way more now. That's really important, I think, for an investor for 2 reasons. One, it's a price-taking capex program in tight capacity, which is music to my ears as a small cap investor. 2, the market's got the amount of money to be spent completely wrong. So I know there's a huge amount of money to be made, or I believe there's a huge amount of money to be made. I don't know anything, but I believe that. Talking to the companies that we invest in and talking to their peers, we can see demand for capacity increasing and that the capacity is very limited and the players are building new facilities, but they're doing it in a controlled manner to make more and more money.
To sort of tying everything together, one, why do you think, because everything you've just outlined at a very macro level, so not the nuts and bolts and the picks and shovels level, right, about capacitors, substations, stuff. I don't think it's news to anybody that we need a ridiculous amount of power, right, and that the current capacity doesn't, is not fit for purpose. I think even here in Sydney, we've had this argument that if everyone bought an electric car, which is like the government's dream, right, and all of us finish work and all plug our cars into our homes between 6 or 7, we will take out the grid, right, effectively, right?
We'd take out the grid if everyone made a cup of tea when they went home.
Well, exactly. Yeah. So in California, I was speaking to another manager recently, and he's based in California, and obviously we know in California everyone's got a friggin' Tesla, right? Okay, they were like the first mover advantage, whatever, right? The greenies. And the government has told the citizens of LA not to plug their cars in at the same time at night because they know that's what's going to happen, and they've had rolling blackouts, right? So I think it's sort of, Captain Obvious that this needs to happen, right? So why is the valuations of the stuff that you're buying for the portfolio not recognized, right? And is that just purely the inefficiency of the market, you think?
There's a bit of that. I think on average, the stocks that we invest in global small caps have 0 to 2 analysts covering them from the sell side. And when you look at mid and large cap, they've got 20 to 30 analysts covering them. So there is some inefficiency. I think the other point is that people look at the large caps and they don't look at the small caps. And this opportunity is for small cap investing. If you look at the large caps serving the electrical upgrade, like GE, like Legrand, like Schneider, like Siemens, like ABB, they're delivering no solid earnings growth. There aren't decent material earnings upgrades, and the stock prices are not going up. Whereas if you look at the stocks that we own, they're delivering 50% earnings upgrades, and their prices are going up. So I think the market's looking too much at the large names and not at the small names. Our top 2 holdings in the fund, Powell Industries and Hammond Power Solutions. So Powell Industries is a leading maker of switchgear for substations and data centers. And Hammond Power Solutions is a leading producer of transformers for substations and data centers, but also harmonic equipment. So I was talking about the 2 different types of power. They're very good at harmonizing that sine wave to making sure that they don't get any bad peaks or troughs from induction. So those 2 businesses have delivered record earnings growth. They're delivering record quarterly operating margins and EPS, and they're expanding manufacturing facilities. The market's pricing them, in my belief, based on my models, like that earnings growth is going to stop in 2 years. That they're going to go back to a world where, so this is something that, for 30 years, the grid was a terrible place to invest in. One of our large holdings, NKT, which is a leading provider of high voltage transmission cables, the leading player in the world, been a strong product for us. They had a negative return on invested capital 3 years in a row in the late teens. So we're talking 2018, 19, 17.
So very recently.
Very recently. Same clients, same utility clients. They did same manufacturing facilities. That's just how bad demand was. And they were telling people at the time there's a huge surge coming, excuse the pun, but they were telling people weren't paying attention. That same company will tell you right now what's coming. They just signed a 15-year agreement with the National Grid in the UK. So they know what's coming. I think generally the market says this thing's rolling over in 2.5 years. It's a mini cycle.
Okay. Yep.
I know the grid's got to double by 2050. I'm looking at the projects right now and the components going into them and speaking to electrical engineers who design these things. The delays are going to increase. So we're behind schedule and we're going to fall further behind, and we're over budget and we're going to go more over budget, which is not news to anyone who's tried to build anything bigger than a bread box.
Which is great for the price-taking strategy, right?
Which is great for the guys who make the goods. And I think, when you look at the guys who purchase those goods, they have to build this line.
Yep.
They have to upgrade the grid. With electrical engineering, although it's complex, there are only certain solutions that you can change where you put the substations on the grid and where you put the load and the generation a little bit.
Yeah.
But there's only really going to be one main solution, and you need transformers. Transformer technology hasn't changed in over 100 years. It's a steel box with copper wrapped around one side and copper wrapped around the other side. It's not changed.
Yeah.
The new technology is involved in helping those hardware. It's not changing the hardware, if that makes sense. It's software helping the hardware, not the hardware changing. So the price takers, they're going to have to buy the stuff.
Yep.
Also, I just note, transmission and distribution is like 2% of your electricity bill. Tax and government's 10%.
Yep.
generation's about 40 to 50%. So, and marketing and the company expenses the rest. So this 2% that we pay on our bill to transfer distribution, it's going to double or triple. The end consumer's not going to see it.
Yep.
And they're going to do it. So I think it's a great place to invest for clients. We're not always going to be invested here. It's just
Right here, right now is where it is. Last question. So one of the most unique things, I mean, fund managers come and see me every which day, right? Pitching the next best thing. I've never met a fund manager that doesn't sell a good story, right? That's the reality of life, right? We're all here for a reason. Now, one thing that I picked up in our catch up just before we started recording was that most fund managers would come in and say, hey, I built a portfolio, right? And our EPS growth and our earnings growth is higher than the benchmark, right? Okay, the forecasted future earnings growth. You're different, right? And we were referencing a chart here where, you know, while your price to book is higher than benchmark, right? For a certain reason, your earnings growth forecast is lower than the bench. Why would I give you money to invest in earnings growth that's lower than the bench? Does it have something to do with risk?
Yes, and the amount of work I do. Most fund managers can put in a style bucket. You can go and buy that style bucket in a passive product that's going to give you roughly the same return. You know, if you're an active manager and you're selling a product that's higher growth than the market and higher price, you can get an ETF for that at 25, 30 basis points. They're not providing you any value. They might beat one year, but they'll come bad the next year. You know what fund managers are like on the active ones. So it's not providing you any value. You're basically buying a souped up, you're just buying, a car that's been a souped up version of something else, right? We can name quite a few car models that are just a souped up version of a rubbish car. But that's what I think you're getting. We're an active manager, so I'm trying to buy growth. You know, we've held in the fund, we've successfully bought and invested in the Trade Desk, in Vertiv, in Medpace, Capcom, Hubble. I can keep going on about them. We're growth investors. But if you're a growth investor, don't go out and buy the shiniest toy on the street, because there's going to be no unrecognized growth in that. The market is about being smarter than the market. If you want to be a passive investor, that's great. Be a passive investor. If you want to be an active investor, you've got to be smart and you've got to use your judgment. Otherwise, there's no point being there because you're taking on risk. And if you're not smart enough to deal with that risk, then don't be there. Being a growth investor, which I am, I'm in small caps to buy the next mid cap, to buy the next large cap. I want to buy the next Trade Desk. I want to buy the next Vertiv. That's why I'm here. That's why all my money's in the fund. But I can't go and buy the sexiest thing because I'm not going to make any money. It's no unrecognized growth. We sold Vertiv at around $100 a couple of months ago because the growth was recognized by the market. It's got to be unrecognized. So my philosophy is go out there and buy much higher quality businesses than the market, because you want to buy the niche leaders. You want to buy the best management teams, the best products, the best services, because they're the most likely to be the leader in the future and grow into be big companies. But then you've got to buy it when no one's expecting stuff to happen. Otherwise, how are you being smarter than the market? I always figured that if you're buying companies that are expected to grow more than the market and they're more expensive than the market, then what do you got? And likewise, if you buy companies that are super high quality and they're cheaper than the market, which is what I like to do, then there's got to be some give, which is that, market's not completely inefficient. Market doesn't expect them to grow. So that's where I like to play. Okay. And that's why I always focus on having a lower expected growth than the market so that we get those earnings upgrades. And I think, what really buoyed performance this year was the big upgrades that we've had. We've spoken about that in some of our main holdings. Right now, small caps are really cheap. And I don't think the market's rewarding the earnings growth that I see coming in our holdings and more broadly across the market.
Okay. Well, Toby, that comes to the end of our time. Thanks very much for joining me on the podcast. Next time, maybe we'll do it on Sydney Motorsport Park, where I'll see you smoking my rear end down the straight, because I cannot do 260 down the straight. Yeah. We'll see you then.
See you then. Cheers. Thanks.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.